Hello traders, welcome back to Nova channel. And let's continue another topic today. Gold faces risk of mid-cycle correction, warning a cool down may be imminent. The gold frenzy and the warning signal from Bank of America. The international gold price is approaching the $4,000 per ounce mark, a level unprecedented in history. However, according to Paul Sienna, senior technical strategist at Bank of America, the current rally is too hot and may soon enter a mid-cycle correction. Sienna points out that the current gold price is approximately 20% above its 200-day moving average, a technical signal often preceding sharp reversals. In the past, similar periods in 2008, 2011, 2020, and 2022 all witnessed gold peaking and then declining sharply in the subsequent months. According to him, the current trend largely stems from speculative flows and political risk hedging sentiment rather than solid economic fundamentals. If sentiment changes or monetary policy reverses, the gold price could see a much deeper correction than many investors anticipated. And now I will share with you a bit about the investor behavior when greed overcomes reason. From a behavioral finance perspective, the current strong rally in gold clearly demonstrates herd behavior. As the price continuously sets new highs, the fear of missing out spreads, attracting massive capital flows from both retail investors and hedge funds. Investors are no longer focusing on fundamental data like real interest rates, global growth, or physical demand from China and India, but only looking at the price chart. A clean side and speculative sentiment is overshadowing intrinsic value. Notably, gold relative strength index is currently above 75, a typical overbought zone. Historical, whenever the RSI crossed this threshold, the price tended to correct by 10 to 20% within the following 3 months. And the next part of today's topic is going to be about the allure of gold hasn't faded, the long-term view of major institutions. Despite that short-term risk warning, Bank of America, Goldman Sachs, and UBS maintain a positive outlook for the medium and long term. Goldman Sachs suggests that if the Federal Reserve begins its interest rate cutting cycle in the first half of 2026, gold could reach $4,500 per ounce. UBS even forecasts a level of $4,900 per ounce, emphasizing a strong central bank demand and capital rotations out of U.S. bonds. Bank of America, while cautious, still set the $4,200 per ounce mark as a feasible target if global economic uncertainty persists and the U.S. dollar weakens. Thus, while the major institutions do not deny the positive prospects, they unanimously agree that the current rally is too fast and requires a healthy correction for solidifying the price foundation. In the next part, we will discuss about technical signal. The overheated pattern resembles historical peaks. Analyzing long-term charts, Paul Sienna states that the current price pattern of gold strongly resembles the peaks in 2011 and 2022, when the price vastly exceeded its moving average, liquidity surged, and the market psychology reached an extreme. In 2011, gold hit $1920 per ounce, then fell over 25% within 9 months. In 2022, the price touched $2,075 per ounce, followed by a correction of nearly 15% within 4 months. Currently, the gap between the price and the 200-day moving average is at its largest in 15 years, a classic sign of a strong overbought market. According to the Fibonacci retracement model, the nearest support zone lies about $3,500 per ounce, with a stronger level at $3,200 per ounce. If gold corrects into this area, it could form a solid base for a new upward phase. And next, we will talk about the market psychology, from extreme optimism to vigilance. The current gold story is not just a technical matter, it's a matter of psychology cycle. In the early stages of an uptrend, investors typically hedge risk and gradually accumulate positions. But as the price continuously sets new highs, greed takes precedence, and herd buying behavior becomes widespread. At this stage, individual investors often believe that gold can only go up, a familiar signal just before the market corrects. Meanwhile, large funds are starting to take parts of profit, reducing their exposure to hedge against risk. Sina comments, a sustainable uptrend requires time for accumulations and conviction in fundamentals. When gold rises too fast, it often creates a very reason for its decline. And lastly, of today's topic, the rally continues, but a rest is needed. It cannot be denied that gold remains the most attractive safe haven asset amidst complex geopolitical tensions, low real interest rates, and widespread fear of a currency debasement. However, the risk of a short-term correction is something investors cannot ignore. The current gold frenzy may only be a mid-cycle correction, a temporary cooling off period before the market enters a new advancing phase. But for those who bought into the rally at high prices, this is a time to be more vigilant than ever. When everyone believes gold can only go up, that's exactly when the market starts teaching a lesson about risk. Paul Sienna, Bank of America. And yeah, that's it. That is the topic today. Thank you for watching and see you in the next video.